Welcome, dear traders. Today, positive data from China supported Asian currencies. The region's stock market started the trading day with red figures. After Wall Street closed near zero, stocks in the Asia-Pacific region were trading lower. Today, China's GDP reportedly beat forecast and accelerated sharply after the indicator was revised downward to 0.5% in the second quarter. Thus, the Chinese economy recorded its fifth consecutive period of quarterly growth. In the third quarter, the country's GDP rose to 1.3%. At the same time, the rise in industrial production remained at the highest level since April, while unemployment fell. On a yearly basis, the Chinese economy grew to 4.9%. Meanwhile, economists projected a 4.4% increase. Notably, the country's yearly GDP target stands at 5%. As a result, Beijing's stimulus measures managed to support the economy after the long-lasting crisis in the real estate market. Over the past 3 months, the country's authorities have continuously injected liquidity into the banking system and kept interest rates low. However, investors continue to worry about China's real estate sector. Bondholders of the country's largest developer, Country Garden, have still not received their coupon payments. On the other hand, strong economic data pushed the yuan to weekly highs, weakening the US dollar in Asian trading. Early Wednesday, the US currency depreciated not only against the yuan, but also against other currencies in the Asia-Pacific region. As a result, the US dollar index consolidated within a narrow range of 106.10 and 106.30 against its G6 basket counterparts. It lost some of its momentum and stabilized near 106.20 against the backdrop of rising Treasury yields and elevated oil prices. In general, the greenback spent the beginning of the day without a clear direction amid several contradictory factors today. First, the deterioration of the geopolitical conflict in the Middle East favors the outflow of assets into the safe haven dollar. And second, recent comments from Federal Reserve officials have shifted to a more hawkish tone. President of the Richmond Fed Thomas Barkin believes that tightening cannot be based solely on a long-term rise in Treasury yields. Meanwhile, President of the Minneapolis Fed Neel Kashkari said that inflation in the country was still too high. At the same time, better than expected U.S. retail sales and industrial production data also reinforced expectations for an interest rate hike. As a result, U.S. Treasury yields returned to the multi-year highs today. For example, the 10-year Treasury note jumped to 4.8%. And this means that the US dollar is now being supported against the backdrop of the strong US economy and the prospect of the Fed's more hawkish and long-term stance on interest rates. However, high Treasury yields as well as high Fed rates act as a constraint. And notably, Fed Chief Jerome Powell will speak tomorrow. After that, markets will hear no statements from the regulator until November 1st. Until then, the US dollar is likely to hover without a clear trend. In addition, soaring Japanese government bond yields put pressure on the US dollar in the Asian trade today. For example, 10-year government bonds jumped by more than 0.8% for the first time since 2013. The Bank of Japan unexpectedly announced the purchase of $2 billion of bonds in order to reduce those levels. Earlier, Japanese Vice Minister of Finance for International Affairs MASATO KANDA said that the yen was still considered a safe haven asset along with the US dollar and the Swiss franc. The official also confirmed that the authorities may raise interest rates or intervene in the forex market in the case of a strong fluctuation in the yen's exchange rate. The Japanese currency is still trading near the critical level of 150 against the backdrop of all these factors. During today's Asian session, the yen was trading lower within the range of 149.50 and 149.90. It appears that the Bank of Japan intervention into the bond market may have a short-term effect on the yen. However, as the US dollar slumped a bit and the Chinese economy showed growth, the Japanese currency was able to recover some of yesterday's losses. The yen strengthened to 149.70 against its US counterpart in the Asian session. The antipodium currencies also recovered their losses today. The Australian and New Zealand dollars will boosted by strong China's GDP data and rising oil prices. The Aussie rose above 0.6339 in the early trading Wednesday as a liquid proxy for the Chinese yuan. However, the Aussie's trading range was not stable today. The Australian currency traded within a wide range of 0.6351 and 0.6395. As a result, its growth momentum has weakened. At the end of the Asian session, the Aussie dollar pair was trading below the daily high of 0.6380. Today, the New Zealand dollar was also trading higher within the daily range of 0.5880 and 0.5921. As a result, the Kiwi closed Wednesday's Asian session, posting moderate gains near 0.59, and the Kiwi dollar pair's future movement is likely to depend on the US currency's exchange rate. And that's all for now, but keep in mind that the market is changing constantly. Subscribe to the InstaForex TV channel, leave your comments and questions below, and we will be happy to get feedback. See you online soon.